First off, with the DOWC, as Brian had mentioned before, we're actually forming a domestic corporation. So this is not an entity that we form, offshore or in an Indian tribe or anything like that. It's actually a domestic corporation formed as a C corporation, and it files both federal and state income tax returns. The tax returns that it files are actually as an insurance company, because this is one of those rare cases where we have an instance where we have F&I products, service contracts that aren't regulated as insurance by a state, but for tax purposes meet the definition of insurance. And therefore, we file insurance company federal income tax returns and then state income tax returns as a corporation. And typically, the way state taxation works is it starts with your taxable income that you have from your federal tax return, and then makes adjustments for things specifically called out in the state revenue code. There are plenty of private letter rulings and technical advice memorandums that support this taxation strategy. In fact, these structures have been around for 50 plus years. So if you're someone who's not really familiar with these and thinks, how do I know this is going to work? I mean, have there been, IRS audits and things? Like reinsurance, these have been around for a very, very long time and typically have stood the test of time with respect to the Internal Revenue Service looking at these things and validating them. One big difference that Brian had kind of alluded to a little bit earlier in the presentation was with the DOWC program, we use something called retail cost accounting. Well, what is retail cost accounting? It means, like traditional insurance programs, we use the cost of the customer making a payment for a service contract as the premium amount. In traditional reinsurance programs, a customer may come in and buy a service contract for $2,500. After the dealership takes its commission, the administrator takes their administrative fees and the clip fees are taken out, and we pay premium tax. That $2,500 may be down to $1,000. And again, in traditional reinsurance, $1,000 is the premium amount. When that premium is booked within a reinsurance program, we set up income of $1,000, and then there's kind of a contra revenue item called unearned premium reserve change of $1,000. So on day one, nothing has been earned, and over the life of that contract, that $1,000 earns out. In DOWC programs using retail cost accounting, we actually recognize that $2,500 as the premium amount. So that's what gets amortized over the life of the contract. The $1,500 in my example of dealership commission, admin fees, and clip costs are all recognized upfront as expenses and expensed when paid. So that typically generates a net operating loss in the DOWC. And depending on the terms of the contracts, the actual loss experience, the volume and increase in volume that we have, that really kind of lays out how these structures are taxed. Typically, if you've got a program with traditional new and used service contracts and some other ancillary products that have 3 to 5 years or longer terms, a lot of these DOWC programs can actually have a net operating loss for the first 7 to 10 years, possibly longer. Again, if you've got someone that's, buying more dealerships and generating a significant increase in premium volume. We typically don't make an 831B election for these DOWC companies until they go into runoff. And, those of you familiar with reinsurance, that's typically the way the reinsurance companies are set up and able to, enable us to make that Internal Revenue Code Section 831B election and pay tax on net investment income only. Again, the DOWCs typically don't make that election when they're operating. And because of that net operating loss carryover, we end up essentially deferring tax for a significant amount of time. We can go to the next.
The retail cost accounting is there for a second, right? That was one of the things that actually a lot of people overlooked when they're building their admin system and all the portals. So Not only do you need to make sure you're getting all that retail through all the different menus and the different pen networks and F&I Express networks, because now retail really matters for all the accounting. If the deal ends up being reworked because somebody did a spot delivery, you got to make sure the dealership accounting or F&I can go back and update those contracts for that retail amount that was actually supported in the finalized deal. And sometimes people sort of want to skip that step because they thought they knew what the contract was, they got it issued, right? So you have to provide that capability to dealership accounting to make sure that in addition to F&I, that is the correct retail price.
And I think, Mark, too, I mean, Brian had alluded to that where we need to capture more of the data, but I think it's important to note here, this is really just a timing difference, because at the end of the day, if our admin fees are the same, our dealership commission is the same, our clip fees are the same, whether we're calling premium in my example $2,500 or we're calling it $1,000, at the end of the day, if all of our premium or our numbers are the same with expenses and reserves, at the end of the day, we make the same amount of money on a DOWC and a reinsurance program. We get the same cash. And in my DOWC, I'm not getting $2,500 of cash. I'm getting $1,000 because the dealership's taken its commission out. We're paying the admin company, we're paying the clip company upfront for those services. It just so happens that we start here in a DOWC program, we actually start in the hole because we've got $1,000 of cash and a $2,500 reserve. As that $2,500 reserve earns out over the life of the contract, we end up eating into that net operating loss. And at the end of the day, if the reinsurance and DOWC programs pay no claims and the contract earns the full term, we're going to make $1,000 underwriting profit in both programs.
Yeah, the thing I was pointing out is from a system standpoint, you'd be surprised some systems didn't pass retail. So if you don't get the retail rate, it's pretty hard to do a good job in the DOWC. So part of what we do, and then make sure that if that contract changed to a different lender, you actually go back and update it so you get the right retail.
One more thing to note too, from a dealership standpoint, there isn't any difference in the way the dealership does the accounting when they sell the service contracts. Right. Nothing changes. You know, the dealership still accumulates the remittance amount, recognizes the dealership commission, and you know that's the extent of the dealership participation.